Hi, welcome to the Everything Money channel. My name is Seth. I'm here with my partner, Paul. We've been here for years talking about investments, real estate, building businesses, and today we bring you a topic that everyone loves. What is a dividend? We've done multiple videos on companies that give a great dividend and give a low dividend, give no dividend, and we're here today to describe what is this. If you've been confused before or you're new to investing, we'd love to go over this. So as a viewer, if you look up any company on Google, Yahoo Finance, or the Everything Money software, you'll see a small percentage number next to a dividend. And what is that, Paul? What does that mean?
So the dividend yield is very easy to calculate. Now, a lot of people don't really, so if you look at the S&P right now, if you buy the S&P ETF SPY, it's paying around 1.7%. dividend yield, okay? So that means if you invest $10,000 into SPY, you are going to make about $170 a year in dividends. Doesn't sound like a lot, but over long periods of time, this can make up for about 20% of your returns. Now, how do we calculate this? It's a very simple calculation. The example before, we talked about a company that paid out $200,000 a year in dividends, right? Let's say hypothetically that company was worth, in the stock market, $10 million. That would be all the shares of the company multiplied by the share price on the market. So to calculate dividend yield, you take the dividends paid divided by the market cap, 2%, because 200,000 divided by 10 million is 2%. Now, as the market value goes up, the dividend yield, if they don't increase it, the dividend paid, the dividend yield will go down. So now, when the stock has gone to 15 million, you're taking the $200,000 and divided by 15 million, which is around 1.33%. So it's the same dividend being paid every year of 200,000, but the stock value has gone up. So if you're a new shareholder at this new value, you're making 1.33%. Now, historically, this is interesting. Like I said before, the S&P currently pays about 1.6 or 1.7% dividend yield. If you go back before the 1985, 1990 mark, the historical dividend yield was around 4 or 5%. In 2000, it got as low as 1.2, 1.1%. Because before, when the market was a lot smaller, people would make a lot of their money from a dividend yield. What they would do is they'd hold a stock and say, you know what? I think the stock's going to do well over the long run, but in the meantime, the reason I love dividends is it gives me some return along the way. I get that cash in my pocket, and the company can't take it away from me. If I buy a stock for 10 bucks, and it goes to 8, I've lost 20%. But if it paid me $2 in dividends along the way, I've essentially made my money back, right? So that's why investors love dividends. It's a cash in their pocket every single quarter, every single year. They just keep getting the money, and it cannot be taken away from them. And they love that. Now, Seth?
Are these dividends guaranteed year to year?
Now, dividends are not guaranteed, and that's the funny part. A lot of people see a dividend yield, they think, oh, well, yeah, I'm just going to buy a company with a high dividend yield. There are a lot of videos you're going to watch of ours. Go watch a lot of our videos on individual companies. What we look at a lot is free cash flow. Free cash flow is cash from operations on the cash flow statement, less your capital expenditures. That's the money they're going to use to pay dividends, buy back shares, make acquisitions, pay down debt, and other major financial decisions the company can make. A lot of times, a company will realize, hey, our investors love seeing that dividend yield, 2%, 3%, whatever it is. They will go borrow money from other banks and other institutions to be able to pay a high dividend yield that they cannot afford. The way to look at it is you get our software, everythingmoney.com. You're able to buy our software, and it'll show you the free cash flow on an annual basis and how much was paid in dividends every year. It should not eat up the entire. There are some companies out there where the dividend yield is higher than the free cash flow. That is one you should be wary of because that is not sustainable over the long run. Okay? So this is a very common theme. I've met with big shot lawyers who told me they were in charge of estates before. This is a true story. They said, I bought this company because of a high dividend yield. And months later, the dividend was canceled because the company couldn't afford it. This is a very common theme. Be a smarter investor by understanding how is the dividend paid. Now, there's something called the payout ratio. The payout ratio is what percentage of the net income is a company paying out to dividends every year. What's the magic number? I don't know. It all depends on how big the company is, what they need the capital for. Are they able to reinvest their capital at a high rate of return, etc.? But if a company makes $1 million in free cash flow every year, I personally like to see less than 50%. $500,000 or less in dividends. because this allows the company to have fluctuations in its operating businesses and things like that allow, because one of the worst things you can do as a company is take away your dividend. So you want to make sure you have enough buffer, because the second that dividend's taken away, people are going to hate you. Just like that's why companies will try to encourage investors to buy their stock by issuing a higher dividend temporarily to get more investors in there. They go, oh, look, there's a high dividend here. Let me buy it. A company, Seth, that your mother worked for decades, AT&T, pays a very high dividend. The good news is AT&T can easily afford that based on their most recent financial statements. But it's very attractive. Why is that? AT&T is so large, it's very, very difficult for them to go out there and generate more business and make real added value to their stock price. So instead, they pay a 7 or 8% dividend yield that says to their investors, hey, listen, if we grow with the US economy, our stock will grow 2 to 4% a year. But you'll get 7 or 8% from us as a dividend, so you're making 11% a year. That's their mentality there. Now, Seth, are dividends always a good thing to be paying out?
Well, I was going to ask you this. You know, I thought if I'm investing in a company, obviously I want to follow the fundamentals to get a great company, and then I would imagine that this dividend yield that I'm getting is just the icing on the cake.
That is one way to look at it.
But
the ironic part about dividend is it's a highly tax inefficient method of making money, and here is why. When a company reports its earnings, what you don't see is if a company shows net income of $1 million, it's a lot different than you and I. When you and I make money on a business, we look at the bottom line and go, oh, look, we made $1 million. Okay, now we're going to take out 35% or whatever the number is, 40% for taxes. And we're left with 600 grand. When a company reports its net income on an income statement, I want you to look at it, because above it, they've already paid their taxes. This is after tax. Their net income on a publicly traded company is after taxes. So they're taking their $1 million after taxes. So maybe they made $1.5 million. When they pay out that $200,000 in dividends, that's not tax deductible. That's paid out to owners. And then you, as an investor, have to pay another tax on there, 30% or so, whatever the capital gain, whatever the dividend tax is. So you've already, as an owner of the company, paid taxes on the profit of the company. And then when they distribute out your holdings, you pay 30%, which is a lot different than if you owned your own business and pay yourself a distribution. Okay? So this is a very tax inefficient way of making money. If the company just saved the $200,000 in their balance sheet, they wouldn't pay any extra taxes. You would not be paying any extra taxes. It's tax inefficient because now they can keep the money in there and reinvest it at higher rates of return. If a company is very good at reinvesting their money at high rates of return, you should not want them to pay you out a dividend. Keep it in there, keep driving up that revenue, keep driving up that profit, and keep driving up that stock price. Because if a stock goes from 10 to 20 and you never sold it, how much do you owe in taxes? 0. You haven't sold it yet.
you haven't realized your gain.
You haven't realized your gain. But if it stays at 10 and they pay out $10 in dividends, you pay 30% on that, you're left with $7. Now you own a $10 stock with $7 in net dividends. You basically lost $3.
I'll be darned, I didn't know this.
So this is the thing. Now, if they also keep that money in there and they keep reinvesting it at a higher rate of return than the market, let's say they have a way of making a return on assets and return on invested capital over 10%, why would you ever want the money in your pocket? But as investors, we've been taught dividends are wonderful. You should take dividends. In fact, I don't know this. I have never verified this myself, but there's been a lot of statements out there saying if you bought only dividend-paying stocks going back to 1925 or something, you'd beat in the market by 2 or 2.5%, which is a huge number. Why is that? I don't know. But the whole point about dividends is it's a very misunderstood concept because people see cash coming in. They don't realize it's after taxes already and they're paying taxes again. It's extremely tax inefficient. And if your company is very good about reinvesting money at a high rate of return, you should never want the cash in your pocket. Go reinvest that and make the company better and bigger.
Okay, that was Paul's take on what a dividend is. If you like what you hear, make sure you tickle that thumbs up. As always, we'd love for you to subscribe, and we have a Patreon if you'd like to learn more. The link is in the description below. Yeah, interesting take on dividends, Paul. I did not know some of that, which is why I'm here, and I'm glad you told me. Thanks for watching, guys. See you next video. Appreciate it.